So in the next few minutes, I'm gonna give you a complete crash course on how futures work. Now, the first thing is futures are not like your normal stocks and buying shares. You can buy a share of, let's say, Microsoft, and it will go up or down over time and you'll make or lose money, but you can hold that share for as long as the company exists. But with futures, you buy something called a contract. And this contract will expire once every either month or even 3 months, depending on what kind of asset you're trading. And this contract's value is tied to the physical asset. So let's say for something like gold futures, as gold goes up or down, your futures contract on gold will also go up or down in value, but usually it'll be a lot more than the price movement of gold. So what this allows you to do is get a lot of leverage on that specific asset. So for example, with gold, is you are essentially buying a contract saying that I will buy, let's say 100 ounces of gold at this current price in the future. And once that contract is used or expires, you have that ability to do that. But in practicality sense, nobody really ever does that. At least for, retail traders like you and me. What people do is they just buy and sell the contracts and get the dollar value increase or decrease of the contract and essentially trade using that. It essentially allows you to day trade with a very high leverage and able to capture up and down moves, just like trading shares. Now, to get control of these assets, you have to put up collateral. It's called margin. And essentially what you're doing is you have, let's say, $500 taken out of your account to get control over one gold futures contract. Now, this margin can depend on either what asset you're trading, how volatile the market is, or if it's during normal stock market hours, which is called intraday margin, or overnight margin, which is outside of normal stock market hours. Intraday margin is usually extremely low because the volatility and risk is a lot less, but overnight margin is a lot more, where you lose a lot more of that leverage potential, and it can take up to 10 times the intraday margin to get control over that asset. Now, you also have something called the micro futures, and all they are is they are a micro tiny asset of the larger normal futures contract. So if a gold futures contract takes you $500 worth of margin, the micro gold futures contract takes $50 worth of margin. So you can essentially trade a very small account. And what this allows you to do is start with a small account and grow it at a normal pace. You don't have to be risking a huge amount of money when you first start out trading. You can trade micro futures and risk $20 or $30 in one trade. Now, there definitely are risks when it comes to trading futures. The margin isn't your max loss on a futures contract. Technically, you can lose more than that if the market moves very quickly against you, especially if you hold it through the close. But really, in reality, I haven't really seen that ever happen. The way to avoid that is a stop loss, always in place when you're in a trade. And most of the time, your futures brokerage will close you out before your account goes negative and you start to lose a crazy amount of money. Now, the most confusing thing with futures is the price movement and how it's calculated. Every futures contract is slightly different. The minimum price movement is called a tick. So if you think about with shares, every stock, like our share of Microsoft, it can move up or down 1 penny at the smallest amount of movement most of the time because it's based on the dollar. Now, a lot of futures are not based on a dollar. With gold, it technically is, but something like the S&P 500 futures, if it goes up a numerical value of 1, that doesn't mean the index increases by $1 value. But instead, one numerical jump is called 1 point, and then the smallest movement possible, at least for the S&P 500 futures, is 0.25, and this is called a tick. A tick is the smallest price movement in the futures market that you're looking at. For oil, a tick is 0.01, and each tick is valued differently. So for oil, if you're trading the normal tick size, not the micro futures of oil, each tick or 0.01 worth of movement is worth $10. For the S&P 500 futures, each tick is 0.25 worth of movement, and it's worth $12.50. And then the micro versions of those are just a tenth of the size. And so you can see where the value and the movement of each chart is way different. Now, the cool thing about futures in the US, 60% of your profits count as long-term capital gains and 40% count as short-term. And so that's a huge tax reduction for long-term use of futures compared to trading other assets. Now, for best trading platform, I highly recommend NinjaTrader. I've used them for over 5-6 years at this point. They're a futures focused trading platform, and they're extremely powerful and easy to execute your futures trades on. You can check it out in a link in the description or this QR code. Now, if you want a complete walkthrough of how I read and day trade futures charts, check out this video right here.